The ECB will continue its policy of QE, of easy money, for the foreseeable future. No, they're not reducing as they said they would. No, they're not stopping as they said would need to happen. They're just continuing the exact same thing they have been doing. Status quo. Business as usual. So don't expect anything positive to come out of this. You came here for the truth, so let me unveil that for you. Today we're going to look at what the ECB has done. We're going to show you the Bank of Japan. We're going to show you the US and so much more. Let's begin. At today's meeting of the Governing Council of the ECB, they decided that interest rates on the main refinancing operations and so on will remain unchanged. That's right, they said they would have to scale it back. They said that this would be the time when they would be reducing slowly but surely, but that isn't the case. And while the markets have been riding on the fact that central banks are knowing what they're doing, are capable, and have been acting accordingly, we know the truth. And that hasn't been happening yet. There's still faith somehow in these institutions. Regarding non-standard monetary policy measures, the Governing Council confirms that the net asset purchases at the current monthly pace of 60 billion euro are intended to run until the end of December 2017 or beyond if necessary. And in any case, until they see a sustained adjustment in the path of inflation, and it goes on. So that means they are going to print nearly $250 billion more than they already have at the absolute minimum. I assume it's going to have to go on for a lot longer than that. So that's what they're saying. Have faith in us. Don't worry. We're going to print more money. We're going to buy up all the garbage, toxic debt. Just have faith in us. Don't worry. And how many times do we have to repeat the same information over and over again before people realize this isn't a joke anymore? It's not funny. It's serious. Because the banking institutions, all these financial institutions, are taking from people every single day. And they don't realize that because they still have a $100 bill in their hand. And they say, look, I've had this $100 bill here for 20 years. And it's totally fine. I still have it here. They don't realize what happens with the value of currency when you do something like this. Most people, in fact, I would say even a large percentage of the people that are supposedly knowledgeable. It just doesn't work like that. You and I, we know the truth. But most people, unfortunately, they don't. So that's what's going on with the ECB. And perhaps I'm going to do another video about the ECB, about something else. But I'll leave that right there. The ECB and the Bank of Japan balance sheets. Look at this here. So the D represents when they said that they would do anything to defend the euro. And then we get into negative interest rates, QE, and beyond. And just look where it was before the financial crisis. I mean, the spike that we saw, it has been expanding. And then as soon as we got into QE, we've seen such a large expansion of, you know, I don't want to call them assets. And I struggle with this sometimes because I want to say the word garbage. A lot of people, if they're new to the program, may not know what I'm referring to, but we're looking at the worst of the worst. Debt. Doesn't get any worse, and yet the central banks print money out of thin air to buy it all up. Japan's reserve balances, I mean, come on. This is not even realistic. If you were to zoom in on, let's say, up until this point here, so in this range here, you would see fluctuations. But because this has gone so into, you know, this roller coaster ride, it looks like here, it just flatlines the whole thing right across. And people think there are no consequences to this. I've spoken with people in the financial industry who have told me that, and these are, VP, at the VP level, okay? So this individual told me that Japan is the model of success of quantitative easing. Okay? And that's not the only person. Obviously, you hear that regularly. So there's some information here that I thought would be interesting. I wanted to bring it to you. As a result of today's peculiar revision, which was not explained by the Fed, total consumer credit declined by roughly $100 billion from $3.856 trillion as of June 2017. Obviously, it's not a big jump in when you look at compared to the total, but $100 billion is significant. So what happened? Well, they did some revising. They get into the reasons why here, and maybe I'll just touch on it quickly. Those revolving credits surpassing the financial crisis peak of $1 trillion as of July are now wrong. And the previous record remains safe, at least for the next few months, because as of today, revolving credit has been revised down to just under $1 trillion, meaning that the U.S. household credit card debt has just been mysteriously revised by $27 billion less. So what do you do when you have too much debt? Well, you just wipe it off the books. What happened with people's credit scores recently, where they just wiped off a whole bunch of things that were giving people bad credit? Poof, it's gone. No more problem, right? That's the way this all works. You're seeing data, but we need to see beyond the data, right? When these revisions come out, we need to be aware of that. We need to know what's happening. When we see inflation numbers and unemployment numbers and every other fake number, we need to know what it all means for real. All right, let's look at the next one here quickly. Obamacare. Okay, everyone loves Obamacare. Everyone loves free stuff. Cell phones are free and everything else. He's going to pay my mortgage. He's going to pay all my bills. And when they brought this in, it was regarded to be the greatest thing ever. Unfortunately, they are now seeing the truth. And that is healthcare premiums rising an average of 113%. Okay, it depends on where you live, obviously, but you'll see that they have been rising an average. Many people have been reporting much higher numbers than this, but let's go with the average here, 2013 to 2017. You don't get anything for free. That's a whole bunch of garbage that we've been told. And you have to remember that whenever they will bring something out, that has to be paid for. I mean, that seems so logical, yet most people don't understand it. They will say, all right, I want a bridge to be built. Okay, I want a bridge from this one place to another, and I want that to be built by the government, and they should do it for me. I want to get to work faster, let's say, okay? So then the government, finally, they get enough support behind it after 10 years, they finally build that bridge. Who's paying for the bridge? Obviously, it's you. You're paying for that. But people think that it's miraculously just happening. The more that we have this government do things for us, the more of a burden we have. The less we get them to do, then the less of a burden they are. That's why people are always demanding more and more and more from the government. Well, that just expands them larger and larger. Don't they realize that? It seems so logical to me. Anyway, this is a 3-for-1 right here, but essentially what I wanted to touch on was consumer debt payments now growing faster than the take-home pay. And it might be hard for you to see on the screen right here, but growth in debt payments began outpacing the discretionary income growth. And that was back in 2016. All I wanted to know was that the amount of debt that people carry is exceeding their wealth. So they just continue to go into more and more debt, and at the same time, they're not able to get what they needed to in terms of their wages. Okay, their wages are basically staying stagnant or declining, and in real terms, and their debt is just continuing to increase. Credit card debt, everything else. Wages and salaries as a percentage of GDP. All right, so that connects in with what I was just talking, and they make it pretty obvious right here. As the years go on, our dollars buy less and less. And it's not just like as if, okay, you're going to be our children and grandchildren and so on will be earning $1 million a year, and that's just an average salary. That's not what I'm talking about. I'm talking about the fact that your wages increase very, very little in nominal terms, but in real terms, that money doesn't really buy you much anymore. And as the years go on, that's becoming more and more obvious. I talk about it all the time. Look back in 1970. This is what I quoted in my first book. Back in 1970, look at what the average person made. That is their average wage, right? What did that buy them? Well, they were able to, first of all, have only one person in the household working. They were able to afford a nice home. They could have a little piece of land. Everything would be fine in that regard. Then we move forward 40 years later, and suddenly it's a very, very different picture because people are unable to afford what they need to have. The basic essentials are becoming more and more of a burden on them. Their rent or their mortgage that they have to pay every month is taking up a large percentage of their income. You look at food prices for those on the lower end are, you know, that actually takes up a significant amount. And for those who are, you know, different aspects here, okay? You see where I'm going. Let me move on quickly. Last one. A tale of two countries. The share of U.S. pre-tax income accruing to the bottom 50% and the top 1% of income earners. This is going back to 62 to 2014. All right, so the bottom 50% of income earners, every year, less and less. But if you're in the top 1%, not even the top 0.01%, but just the top 1%, okay? Their wealth continues to increase. The rich get richer, the poor get poorer. Okay, that's a very obvious, very simple thing to understand. You and I know it, so I'm glad that we could just prove it here with these charts. I'll leave it at that for today. Stay tuned for the next one. You know it's not too far around the corner. I know that there is so much positivity out there for this channel, and I just want to thank you all. If you found this video informative, please give me a thumbs up. If you haven't already, you definitely want to subscribe, because subscribers to this program get to be notified every single video I do, which I post at least once a day on average. And recently it's been even a little bit more than that. So you definitely want to stay tuned. Do not miss a video, because I'm doing so many that, you know, I'm covering all different types of topics. So it's important that you catch them all. There are now over 65,000 people on this YouTube channel, and want those of you who haven't clicked the subscribe button to join me and join the others. Last but not least, if you found this video informative, I know you'll find my books, The Money GPS, and my new release, Global Economic Collapse, even more informative. You can flip through these books at Amazon. They have a look inside feature that will allow you to do that. The first book is about the 4 asset classes and how to profit from them, whereas my new book gets into different topics as well as covering familiar terms. Becoming self-sufficient, reducing your monthly expenses, and solar panels and the like. So check those out. Links are in the description below. And one more thing, if you haven't already, then you want to catch me on Steemit and VidMe as well. So those links are in the description. Basically, Steemit, for those who don't know, it is a blockchain-based social media platform. Very, very clean look to it. You can get on there. It's something that I think is has been good so far. We'll see where it happens to it, but there are about 600 people on there, so it's quite a different size group. But I post all of the videos I post on YouTube, I post on there as well, except there is no worries about the issues that I had gone through in the past, so I won't talk about it on here. But none of those issues are apparently going to be present on that site. So Steemit's pretty cool. Links are in the description. Take care.